Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
Welcome to This Week in Money. I'm Jim Goddard. Today, David Morgan believes there are unique investment opportunities we haven't seen in 3 decades. Inc. Research CEO Ted Dixon tells us what sectors will be best bets. And Web of Debt author Ellen Brown calls for a massive reform of the U.S. banking system. We talk to David Morgan right after this.
The best of the best. Randy Elvis Frisky and his Las Vegas show band with Cassandra Frisky. September 14th at the Sagebrush Theater. Tickets at Kamloops Live box office. Call 374-LIVE. Details at randyelvisfrisky.com.
Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is David Morgan, author of the noted Morgan Report investment letter. David, welcome to the show.
Well, thank you. Great to be with you.
Well, This Week in Money is going to hear about, have we seen the bottom of the gold market, and is it for real? And is everything overpriced out there except mining stocks? Well, let's take a look at the gold market first. Has gold bottomed out? Could it go any lower than it is right now?
Well, could it? Of course, the answer to that is always certainly could. I really doubt it. I think that the bottom is in. I've called the bottom of the silver market, and that applies to gold as well. If you go back technically and look at the charts, if you look at the 28th of July, 28th of July, we have what's called a key reversal in silver, and you can look that up on Google what a key reversal is. Basically, hit a new low, and there's tons of buying at that new low during the day, and it sends it up strongly and closes at a high that's higher than the previous day. That's called a key reversal. So that took place, and ever since then, the whole month of August, we basically trended sideways in silver around the 1950 level. And the 2050 level is kind of the breakout point. We saw that. I called for a rally, and basically we've seen it. I think it's got more to go. But both gold and silver, I think, have found their intermediate bottoms here. I'm talking about recent time, meaning from the high in silver way back in April 2011. It's been well over 2 years now. I think that bottom is in for that consolidation period. It's the right amount of time, the right amount of sentiment, and certainly the key reversal. So factoring all I know, it looks like the bottom is in for silver, the bottom is in for gold, and we are not out of a main uptrend as far as the long-term bull market is concerned. There's many or some that think that the bull market's over. It's not, but I have to be fair. To be absolutely positive that the bull market isn't over, we do have to establish new highs. So we'd have to see gold go to the 1900 level approximately, and silver back up to that 50 level and penetrate it and keep on going. And I think that will happen, but I don't think that's going to happen in 2014. I think we're probably going to have to wait into the 2015 time frame before we see that. Although, let me back up on that. I'm sorry. I think we'll see new highs. First of all, when, no one knows. I'll be the first to admit that. I think it's going to take some work. In other words, if it took 2 years to consolidate and come off the bottom, and there's lots of resistance on the way back up, it's probably going to take some time to get through those levels. And we do need to get through those levels to prove that we're still in an absolute bull market. Once that's achieved, then I think you'll see an acceleration to the upside. So knowing what I know about how markets move, I would forecast that you're not going to see this real frenzied market action probably for another year and a half or so. And again, using those numbers as a baseline, it's an area to keep your, to note and to remark on, because if you're a momentum player, really the safest thing to do, I'm not suggesting this, but if you play momentum stuff, the $1,900 level in gold and the $50 level in silver is actually a great momentum play, because once you get through those levels, you will see an acceleration.
Of course, the whole idea is you want to buy these precious metals for as little as possible. So right now seems like a good time to start stocking up.
Well, absolutely. I think the, safest place to start is, where we are now, because you have a confirmed bottom, or at least I think you do. And so you want to buy after the bottom is confirmed. It's safer. It's less risk. And secondly, you get the best gains. Certainly, the acceleration phase I just mentioned is the area where I think the biggest money is going to be made. I really think that. But it's also an area that's rather treacherous, because you get so much momentum and these metals keep going up and up and up. And of course, underlying that are the mining shares that will go ballistic, in my view. It gets into this huge feeding frenzy, and then no one wants to call a top or take profits, and that's a mistake. I lived through that myself once. I'm old enough to have been through the bull market in the previous decades, in the 1970s through 1980, and I know that you get stung by greed, and you can get a little bit caught up into it. So I'm trying to stay very objective this time, and be able to stay calm, cool, collected, and take some money off the table on the way up.
It's always a good idea to have a long-term investment plan, and if we're expecting prices to go up, this would kind of fit into that plan.
Well, exactly, and we're addressing, once we get there. I mean, the market knows more than anyone. I've constantly said that, and I constantly try to obey that. And based on market action, we'll make some determinations. But we're a long ways from worried about a top right now. We're basically, as I said, confirming a bottom. And if you're new, it's a good time to get in. If you're not, you certainly want to hold what you have. And lastly, I think we might want to look at the mining shares, because that's the area I think you've got the greatest leverage by far, and probably the lowest risk right now. I
saw a headline in an economic paper that said everything is overpriced except mining stocks.
I think that's fairly accurate. I mean, I do my own grocery shopping these days, and I have in the past. I don't want to dwell on that. But the point is, I think just about everything is overpriced. But the mining shares are at a huge discount to the underlying metals. The only caveat really is to be sure, if you're playing in the junior space, you're playing in a micro cap area, be extremely careful, because even though the bottom is probably in, some of these companies are so low on cash in the treasury, they may not be able to survive, even if they have a good asset base. So you got to be careful on the micro caps or these smaller junior mining companies or exploration companies. But if you're looking at the mid-tier on up, certainly there's value there right now that's probably not been available for 3 decades. So this is an area that you really want to focus on for, solid investment. And certainly if you want to speculate into the, junior/micro cap area, certainly. My biggest concern is that most of the letter writers out there focus on the micro caps only, or significantly in that space. And these guys have been devastated. I mean, just so many of these companies are no longer existing. So, we try to balance risk with reward, and therefore we have a top tier, a mid tier, and a speculative section of the report. And by doing that, certainly I wouldn't say that we've done great the last couple of years, but relative to a lot of my peers, we have, because a lot of these companies, are still viable and continuing. And to be fair, we've had a couple that kind of blindsided us. We had one that was going into full production, or announced full production, and basically they pulled in their tentacles and said, well, we're not going to produce, and now it's sort of iffy if they will or they won't. And there was another one that was similar to that. And these are both speculations, which I teach people, bet a little to win a lot, and don't bet more than you can afford to lose. So I don't have any guilt about recommending them. But nonetheless, these were producers or near producers, and yet they failed as well. So you do have to be careful. I mean, it is a tough business, but again, risk and opportunity. You have an opportunity here that I know is a once in a 3-decade opportunity. You have not had the discrepancy between the price of gold and HUI at this level for 30 years. So if you want to get in a once in a lifetime opportunity, get into the mining shares, diversify, spread out, allocate your capital in a judicious manner, and hold on for the ride, because I believe this is going to be one of the biggest rides you're ever going to take.
Taking a look overseas, China, of course, how its economy goes, now it seems there goes the world as well. And I was really surprised to find that the Chinese are a nation of savers, perhaps saving at least half their income every year. Why is that?
Well, I'm not sure it's that much, although I won't argue. I don't know the facts. I know they do save a great deal. And the reason is that they're motivated by their own self-interest. In other words, there is no, real socialism there. There isn't a social security system per se for the Chinese. So they're basically on their own. And so that's a motivation. I mean, if you're motivated because you are responsible for whether you eat or you don't, and you're responsible for living off your savings in your old age, and no one's out there to help you, there's no, big daddy that's going to come to your rescue, then that's a huge motivation. And this is the whole idea that I've been trying to get across for years now, is that the Chinese mentality is much, much different than the West, and that they are motivated. These people there, especially the younger people, know that they have to perform. And so this huge motivation continues. Now, that doesn't say that China doesn't have problems and they haven't overbuilt their real estate markets and all the negative stuff that you hear about. But the productive capacity of China is yet to be realized. And the ingenuity in China is gaining a great deal. So I think in the long term, you're going to see what I forecast, in the 2000s, early 2000s, is a huge shift in wealth, the wealth from the West to the East. And as an Austrian economist, you look at what is the means of production. In other words, who's making wealth? Who's taking assets out of the ground? Who's growing? Who's manufacturing? And that's basically China. I mean, they're manufacturing most of this stuff and selling it for basically paper money. And so they're wising up to that as well. And not buying nearly as much debt off the U.S. Bond market as they used to. So there's a big, big shift going on. And again, they're super, super motivated. They are not relying on the state to take care of them per se. I'm not saying the state isn't involved. I'm not saying that. What I'm saying is on an individual level, they're much more motivated than, let's say, the average American citizen.
I've heard the comment that the Chinese now appear to have more economic freedoms than America does.
Well, I'm going to get some people upset with me, but having been there and walking the streets and seeing how it operates, certainly in a lot of levels, that's true. I mean, you could put up, for an example, a hot dog stand that starts selling hot dogs in the streets of Beijing. To the best of my knowledge, I could be wrong on this, but you can put up businesses without all the red tape that it would require here. You have to get the health department out there, and how much space, and get a license and another license, and get the city license, the county license, the state license, the national license, the health inspector, the EPA statement, and all this other stuff to start a business. They can start a business fairly easily, much easier than you could in the West, for example, in most cases. So that's more free market. I mean, and now the market decides whether your hot dog stand is worth it or not. You either draw people that buy it and make a profit, or people say, no, I don't want your product, and you fail. That's real free enterprise. And yes, it does take place in China, and in some cases it's true. But, you say that and you get people upset, and I don't mind getting people upset, believe me, because they've got this preconceived idea. One, they haven't ever been there, and two, they've been brainwashed. They believe that, these nasty, horrible, rotten communists are running everything and people have no freedom. Well, I'd say take an objective look at what you can and cannot do in both those locales and make your own determination who's got the most freedom.
What about corruption in China? Do you have to be careful of that if you're investing there?
Yes, and I think that's true across the board. I mean, let's face it, the moral degradation is huge across the planet. I mean, if you go back and study history, the main thing that made the West so great was the rule of law. In other words, if you went into a business deal and it failed because your counterparty, your business partner, for an example, cheated, you had the remedy of law at your side. Now, that doesn't exist in China. And so that was what made the economy so prosperous, is that you basically had to do what you say you were going to do. And if you didn't, you had the court to back up and cause, performance to take hold, or there's a legal remedy to it. So you had to live your word. But that's kind of passé now. I mean, if you're objective, you can see that some of these biggest crimes in the financial world that have taken place in the last several years, there aren't any repercussions. You look at what the investment banks have done, and they get bailed out. Well, they get bailed out on who? The backs of the people. You got this John Corzine, I can't remember where $1.6 billion went. The MF Global debacle. Then they put everybody in PFG and it fails. I mean, there's example after example of corruption throughout the system, and yet in a lot of cases there's no legal remedy whatsoever. Sure, they got the Bernie Madoff and they get an occasional this or that, but look at how many of them slide by and nothing happens. So the whole idea of living your word and doing what you say you're going to do and being it backed up by the rule of law has become an idea whose time has passed. We're in a corrupt world globally. So if you want to point fingers at China, go ahead, but I think you ought to look at, where you're pointing, because as far as I'm concerned, corruption is pervasive, probably more in the West than in the East, and yet it ought to be fair. In the East, you do not have the legal remedies that was so powerful and so important and was basically the foundational situation that caused us, the West, to be the economic superpower at one time. Since we've lost that status.
David, thanks a lot for chatting with us.
Well, my pleasure. Thank you.
David Morgan is the author of the noted Morgan Report investment letter, which you can find online at silver-investor.com. Coming up, Ted Dixon on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Ted Dixon. He's the CEO of Inc. Research Corp., and Inc. is spelled I-N-K. Most people think it means incorporated. Welcome to the show, Ted.
Well, it's great to be back, Jim.
I know you were here in the spring with Phil. Now it's still summer. Darn it. We have to take the shorts off in Vancouver. It's winter, and that may not be until about December 1st. Anyway, it's summertime, and we're taking a look at some big changes in the market. Everybody tells me it's kind of the calm before the storm.
Sure. Well, let's take a look at what's happened since I was on at the end of June. When we were discussing the market back at that point, the big thing that stuck out in our screens was the amount of insider buying in the mining area. And as it turned out, we're right around the bottom in the S&P TSX mining index at that point, and it's had a nice rally since then. And much to the surprise of many commentators, actually the gold and mining stocks have been the best performing stocks in North America over the past month. So insiders were pretty good in terms of their timing. They peaked their buying at the end of May, and then the market kind of bottomed at the end of June. So, and that leads us, Jim, into one very important point, that your listeners should keep in mind as a rule of thumb, is that insiders are usually early, and it's good to follow them, but you may not want to move right in lockstep with them every step of the way. It gives you time to kind of sit back and assess things. So here we are, and we're in the back stretch of summer, and mining stocks have been regaining some lost ground. And from our perspective, they still look to be in an attractive area, although not as attractive as they were back at the beginning of summer.
Well, I talked to a Simon Fraser University professor who said that commodity prices over the long term are going to decline. Now, does that encourage people to get into mining stocks?
Well, we look primarily at what insiders are signaling. We take our cues from that. And so we would look out a year or 18 months. We wouldn't be making sort of a long-term, multi-year, decade call on these sectors. But what we've noticed is the insiders have been buying quite a bit, and at the same time, it looks like the U.S. Federal Reserve is starting to give more attention to the inflation problem in the United States. And why is that important? Why is inflation important? Well, two key reasons for mining investors, and over the next year or 2 years in particular. First of all, inflation is a key worry for the Fed. It's in their mandate. Legally, they have to worry about inflation. And inflation is actually going down. Now, many people will say, no, I don't believe you, Ted. Inflation is going up. Well, asset inflation is definitely going up. Housing prices had been going up in the U.S. They're certainly they've been going strong in Canada. Things like university tuition has been going up, but goods and services prices haven't been going up in the United States as much as the Fed would like. In fact, when you look at what has happened in the past 2 years, since the Federal Reserve met in August 2011, the PCE, which is the Personal Consumption Expenditure Price Index, has been dropping. It's been going in the wrong direction because the Fed wants to see stable prices around 2% inflation a year. So we're just a little bit above 1%. The trend has been in the wrong direction. And
can I ask an evil question right here?
Sure.
Goods and services not going up. Every economic study done on why North America has done so well for 250 years, we had a lot of consumers who were buying goods and services. If I'm not going on vacation because I'm working part-time, I'm not buying a lot of goods, and I'm certainly not going to use the services of a hotel concierge. So has big business in the U.S. killed itself?
Well, I think, there's a number of factors. First of all, prices have been going up a little bit, but you have to put it into context in terms of the costs of these companies doing business. And they need to be able to, small businesses in particular, need to be putting up prices. And if they don't have the demand, as you point out, from people with good paying jobs to spend money, they can't put up their prices. And this has been one of the problems in the United States. And in fact, when the Federal Reserve released its minutes on Wednesday, a number of people in the Federal Reserve Policy Committee were concerned about exactly that point, Jim, that there wasn't a lot of firepower amongst consumers to keep prices at a level that the U.S. Federal Reserve considers to be appropriate.
Well, the analysis is, sure, jobs are up, but people who had really good full-time jobs are working 2 or 3 part-time jobs with no benefits.
Well, that's correct. And particularly in the U.S., you're seeing a lot of re-engineering of the job market because of the healthcare changes that are coming in that favor part-time workers. So a lot of the hype in the job creation numbers you've heard out of the U.S. is because there have been full-time jobs that have been split into part-time jobs. So even the cheering that's going on the unemployment front is perhaps a little bit overdone. And with inflation not moving up, the Fed has to worry about that. And so we've seen a rebound in gold because a lot of investors are probably thinking, okay, the Fed knows this, and in the minutes that were released on Wednesday, a number of committee members were concerned about the direction of inflation. They are aware of this, and they will have to continue to provide the economy with lenient monetary policy, and that's good for gold. So the important thing that your listeners that are going to be looking at the market over the next few weeks is look at what happens on August 30th. Just before everyone goes away with long weekend, out will come the July PCE prices in the United States. And if they continue to trend down, the U.S. Federal Reserve will have to come out and make a statement at some point saying, this is not acceptable and we're going to continue to provide easy money. If, on the other hand, inflation moves up, that's not bad for gold as well, because the other important aspect for inflation on the price of on asset markets is the effect it has on the price of gold in relation to interest rates. So we know that the U.S. short-term rates are going to be held steady for the next year or two. The Fed has said that. We're not raising rates. But if inflation falls, the real rate disappears, and it becomes the real rate goes up. And that means the advantage for gold disappears. So if inflation is falling and interest rates go up, or interest rates don't go up, then we've got a situation where real rates are rising, and that is bad for gold. If inflation starts to move up and you have interest rates stay steady, then we have a scenario where real rates are falling and gold can start to make a bit of a comeback. So I think you've got a couple of scenarios here that are favorable for gold. What would be very bad for gold and gold stocks would be if inflation falls and the U.S. Federal Reserve comes out and says, well, we don't really care. We don't think inflation's a problem. We're going to start tightening monetary policy. That would be very bad, and that would be the one scenario that could really throw a monkey wrench into the rally that we expect to continue to see in mining stocks.
Well, right now, it seems every time somebody at the Federal Reserve blinks, the market takes off one way or the other. Have they finally learned that, policy will probably be very conservative and it won't really change a lot because they don't want to upset the boat?
Watch what they do, not what they say. I think that's the rule that investors have to follow and try and avoid, just try and put all that noise aside. You're absolutely dead on in terms of, the volatility that these comments make, and it's more important what they actually decide to do as opposed to what they say they might or might not do. Because the truth is they don't even really know what they're going to be doing, and a lot will depend on where the inflation rate goes over the next few months.
Now, little old Canada, a member of G20, a lucky member of G8 because California's economy is bigger than ours. Anyway, our finance minister, Jim Flaherty, said Canada's monetary policy and fiscal policy is very different from the U.S. He doesn't believe in printing a lot of money. He said the most important thing he can do to protect Canadians is reduce the government's deficit to zero, and he plans to have a balanced budget by 2015. Does that affect the world at all, or pocketbooks for real?
Well, in terms of the Canadian stock market, outside of the financial sector and the consumer sector, it probably doesn't have a big impact. We would not expect to see a lot of insider reaction to those types of statements by the Canadian finance minister in the resource area. What would be more important for resource investors would be actually, I think, some of the developments at the provincial level. The election in BC of the Christy Clark government was a positive, for example, for natural gas development. If you had some sort of change in one of the, in Alberta or Saskatchewan, that would impact resource markets, but the federal government really, outside of the banking, real estate investment trust and consumer spending area, probably doesn't have a big impact. It's more what happens in the U.S. in terms of monetary policy and also, what may be happening in China.
Just a little political, I'm sorry here, very dry mouth, a little analysis of what happened in the BC election. Do you think electors took a look at what was offered and went, my God, am I in favor of business or not?
Well, I have to, I do have a bit of a conflict of interest. I was Christy Clark's policy chair for her leadership campaign, so I'm quite
well,
biased,
it worked, sir. It worked.
So, that being said, I think, she framed the ballot question. Do you want to take a chance on a party that is kind of waffling on resource development, or are you going to support a more aggressive pro-development stance in terms of natural gas development.
And of course, we had the great battle, the discussion about if there's a pipeline to Kitimat, getting resources out of it, and the two premiers of Alberta and BC standing up for their provinces. And I have to say, being born in Calgary but spending most of my life in BC, I'm proud of both ministers or premiers standing up for their constituents. I think in the end, it just makes a stronger country and probably a stronger economy, knowing that, yeah, you're right. Provincial governments, when it comes to development, probably have a much more of a range of powers and influence than the federal government does.
Absolutely. And you're absolutely right. Both Christy Clark and Alison Redford are doing their jobs. They're looking out for their electorates, and that's what they're supposed to do. So, we'll see how that plays out. The federal government would have a role in terms of the licensing for the export permits and environmental
and the federal government outranks any provincial government
on those issues.
On anything, they can change the law in so many different ways so quickly.
Exactly. So we'll see how the Enbridge pipeline and Trans Mountain pipeline issues evolve. But those are certainly aspects of Canadian public policy discussion that could impact resource investors. But fortunately, unless there's any big tax changes that Jim Flaherty has up his sleeve that he hasn't told us about, I don't think there should be any surprises from his office in terms of...
No, he said his new budget will probably look very much the same as his last budget. He wants stability. He just wants to get that deficit clock turning the other way again.
Well, certainly wish him well on that, and hopefully he sticks to his guns. And the real worry for investors will be how monetary policy in the United States plays out, and hopefully, of course, Europe can keep its house in order so that there are no surprises coming out of Europe. But insider sentiment is in Canada. There's kind of two camps right now. There's the resource camp in the mining, which is very good. The financial services insiders are pretty upbeat in most areas, but there is I would say there was a little bit of a pullback in the REITs a couple of months ago, and we're starting to see insiders come back in and buy the REITs, but I think it's still early there to see how that's going to play out. Technology has some interesting activity going on as well, but that's more of a company-specific basis, and I'm not talking about RIM, I'm talking about in the Canadian market, there's a lot of smaller companies that you can look at, and if you go to our website, intresearch.com, and you can get a 2-week trial subscription, you can go through the technology sector and see which stocks insiders are buying there, and they're all the opportunities are very in some names that people probably haven't heard of before in the past. So there's a lot of interesting things happening in Canada at the stock level. One area that is probably cooled off quite a bit is in the consumer cyclical area, and in some of the household names that there's been they've had a good run, some of those stocks, and a lot of the insiders are taking profits there. So resources and financials, the banks, the insurance companies are all looking pretty good from an insider perspective, and select technology names as well.
Thanks a lot for chatting with us, Ted.
Thanks very much, Jim. Appreciate the opportunity, and enjoy the rest of your summer.
Thank you. After the break, Ellen Brown on This Week in Money.
The best of the best. Randy Elvis Frisky and his Las Vegas show band with Cassandra Frisky. September 14th at the Sagebrush Theater. Tickets at Kamloops Live box office. Call 374-LIVE. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ellen Brown, author of the book Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. Ellen, I have a feeling that this is sort of connected to Detroit declaring bankruptcy. Is that just a symptom or what we can look forward to in the future?
Well, it sounds like a template. It's rather like Cyprus, which was a little country in distress, and your first thought was, well, they're just in particular trouble, and so this is an emergency measure. But it was like a shot across the bow. This is the way it's likely to be, and then the next one will be less of a shock when that happens. And now we know that that's the template because the Financial Stability Board has come out with a directive requiring all too big to fail banks to come up with some sort of plan for what they'll do if they don't get bailed out by the government, which of course they won't. And that was set in place in 2011, and we're only now hearing about it. So,
who is this Financial Stability Board? I never heard of them before.
It used to be called the Financial Stability Forum, and it was just guidance for the big banks. But in 2009, after the 2008 crisis, the G20 nations all signed on to be regulated by it's now the Financial Stability Board, and it's required. They actually set the rules for the big banks, and we, not we the people, but we, our leaders, agreed to this. They all shook hands in London, and now we're bound by it. So
a secret agreement, in other words, or more or less,
well,
they didn't say officially a secret, but I didn't hear trumpets blowing either.
Well, it was, I wrote about it at the time, and when it was certainly in the news, but the implications were rather secret. It just sounded like a good idea that they were all going to get together and figure out how to prevent another big collapse and regulate the banks and so forth. It sounded like a good idea. But if you look closely, their mandate was huge. I mean, it was very broad. They could regulate all sorts of things, and that's That's what I wrote about at the time. And now we're seeing what they're actually doing with it. But because they had this broad mandate, it should have been a treaty, and it should have been voted on by 2/3 of the Congress, but it wasn't. It was just a handshake by President Obama and other leaders.
With this in place, do you think it's going to make the world's banking system more stable?
No, what's going to happen is the next time we have a Lehman Brothers type collapse, whichever bank it is, I'm guessing maybe Bank of America, because they have over $70 trillion in derivatives and over $1 trillion in deposits, and their investment arm, which is Merrill Lynch, is quite shaky. So if they go down like Lehman Brothers did, they will snatch the deposits. And when we, the depositors, try to object, they'll say, no, we were required to do that. We put that in our living will, and it got approved by the Financial Stability Board. So we won't even have a say. It will all look like something legal that these rules have been passed. The reason for the whole thing, of course, is that the governments are refusing to bail out the banks in the future. We refused the U.S. refused in Dodd-Frank. There's a provision that if we're going to let you banks continue to gamble in the derivatives market, as you have been doing risky things, but if you get in trouble next time, we, the taxpayers, are not going to bail you out. What they should have done was said, we're not going to let you play those games anymore. But instead, they've allowed, they haven't reimposed Glass-Steagall, which means that the depository arms and the investment arms the funds are all commingled. So if they have an investment problem, meaning a gambling problem, it's going to come out of our deposits.
I thought the banks were supposed to come up with a plan where they would have enough assets on hand that they wouldn't be in danger of failing if there was another downturn.
Well, they won't fail, but what they're calling assets is the IOUs of their creditors, which means our money. It turns out that depositors are creditors. We're not bailees or bailors. I forget which is bailees. We're creditors. We've got an IOU and they've got our money. So they actually own the money once you put the money in the bank. That's the law.
What about our guaranteed deposit insurance?
Well, in the U.S. we have a fund to guarantee 6 trillion or so deposits that consist of $25 billion. In other words, it's something like what's under 2% of the deposits are actually covered by this fund. Now, it used to be that the fund, the FDIC, could go to the Treasury and get a credit line for any excess they needed, and that's what they did do when they went over in 2009 by $8 billion. But then the banks that paid premiums to the fund had to come up with that $8 billion, and even that was a stress for the little banks. Now think what happens if we have another $700 billion crisis. Who's going to pay that? And Dodd-Frank now says that we, the taxpayers, are not going to pay it in the event of a big derivatives collapse. So the Treasury, it appears, under Dodd-Frank, the Treasury is going to say, sorry, we've been told that we can't bail you out this time. We can't bail out the fund. So that's why the banks have this thing all in place, where they say, well, we're taking first we'll take the shareholders. You know, they do it in a sort of logical sequence. First we wipe out the shareholders, so don't even think about buying any bank stocks. Then we're going to wipe out the bondholders, and then we're going to wipe out the unsecured creditors, then the secured creditors. And we the people are in the unsecured creditor class, but we're supposed to be protected by this other agency. It's not the bank's problem, it's the FDIC's problem. But the FDIC will say, sorry, we don't have the money.
So that $100,000 guarantee, you can't lose that, really isn't a guarantee.
Right. You've got a claim against the FDIC, but the FDIC doesn't have the money. They're going to have to say we're bankrupt. So that's the very model that they're doing in Detroit now. You normally think of a bankruptcy where if you don't have, like a Chapter 9 bankruptcy, where you don't have, the company doesn't have enough money, they put the money they have into a pool, and then they divide that up fairly among the creditors. But in this case, because of the Bankruptcy Reform Act of 2005, creditors that get super priority in bankruptcy are the derivatives players. So this makes no sense. I mean, these are the banks that actually caused the crisis, or the big Wall Street banks caused the crisis. They caused it by all sorts of fraud in mortgages and the subprime crisis and the liar's loans, etc. And they caused it by persuading the cities, or actually they told the cities that if they were going to do their bond issues, that it was best practice to protect their bond issues with these interest rate swaps. So this is a form of derivative. And they didn't tell the cities, this is a form of gambling and we are going to be the counterparties on the bet. In other words, you are betting against us. And one of us is going to win, and the one that loses is going to pay a lot of money to the one that wins. They didn't explain it that way, I'm sure. I wasn't there, but you can be sure that the consequences of this bet were not explained to them. So here the banks are going to take first from this pool of money, which they actually caused to be insufficient to fund the budget in the first place. And then you go down the line where the secured creditors and the unsecured creditors and the pension funds are way at the bottom. They're unsecured.
So pensioners have to pay it. People will have to pay with their savings accounts, but not the big banks.
Well, the pension fund will just get wiped out. In other words, they just won't get their pensions. So these city employees, that have been fighting fires for 30 years or whatever they've done for the city, are suddenly going to be out in the street when they retire.
More with Ellen Brown next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. I'm Jim Goddard. We're speaking to author Ellen Brown. Do you think these rules are being implemented because they expect another round of banking failures?
I think definitely. That would be true of the bail-in procedures, but I think for the cities, all the cities are in trouble, or having trouble balancing their budgets. And once they have this model and they say, oh, look, Detroit managed to get out of their debts by just declaring bankruptcy, we should do that too. But what they're not looking at is who's going to get hurt and who's going to benefit from all this. What they should do is repeal that super priority thing of the 2005 bankruptcy law. And in Detroit, for example, in Michigan, the Constitution protects pensions, so they should respect that. But apparently the argument is that the federal rules trump the state rules.
Are Canadian banks in danger? Will they face the same kind of conditions as the U.S. banks?
I haven't looked at their books, but you have to suspect that they are, because they also have these bail-in things in place. And why do they bother if they're so confident that nothing's going to happen? Of course, I think maybe they're forced to do it under the Financial Stability Board regulations.
Right. So even though you may have national regulations that say one thing, the Financial Stability Board would overrule them.
Right. That's the shocking thing.
You've lost your sovereignty.
Right.
Should the U.S. Treasury take over the Fed Reserve?
Well, it should certainly be. They should redo the Federal Reserve Act. I don't know if the Treasury is. I don't necessarily trust I mean, whether you can trust the people in charge of the Treasury is another question, but they should redo the Federal Reserve Act so that the mandate is actually to serve the public instead of having it. Currently, the Federal Reserve is composed of 12 branches, all of which are 100% owned by the banks in their district. And those banks have a lot of leverage on what the Federal Reserve does. Supposedly it's an independent central bank. Well, what that means is independent of government, but they're not independent of the big banks who are actually their constituency, and that's actually who they work for. So that should be changed. They should they operate like the Bank of North Dakota, for example, which is our only state-owned bank, and it actually has a mandate to serve the public, and that's what they do. They're civil servants. They don't make there's no benefit to not serving the public. They get promoted for doing a good job serving the public, and they do.
Britain brought in legislation that says banking executives would be criminally responsible if a bank goes under and could face jail time. Would that happen in the U.S.?
It certainly hasn't happened yet. It's highly unlikely, it seems to me. But in the Middle Ages, they actually beheaded bankers that couldn't balance their books. I mean, there is precedent, but it goes way far back.
I'm sure a lot of people who lost money in the recession feel that way.
We'd enjoy watching that. That spectacle.
Is there any practical solution to this system to make it safer for consumers?
I think we have to move as a group. People say, what should I do with my money personally? But there's really no safe place you can put your money. The stock market, the money market, they all put their money in overnight sweeps in the Wall Street banks. They make a teeny bit of interest, and meanwhile they're putting your money at risk of being swept up when that bank goes bankrupt. Credit unions and community banks, they use big correspondent banks, which also do that sort of put their money in big Wall Street banks or invested in these dangerous things. Do you know where your money is overnight? That's the question.
Just like they used to say on the radio, do you know where your kids are tonight?
Exactly. You could buy a safe and a shotgun and a mattress, but...
Well, the interest rate isn't all that good, but at least you know where your dough is.
Right.
Ellen, is there a website people could go to find out more about what you feel about the banking system right now?
My website is webofdebt.com, and my blog is linked to that. It's loaded with information on how you can encourage your politicians to set up a public bank and, what you'll need to tell them.
Thank you very much for chatting with us.
Thank you.
Thanks to our guests, David Morgan, Ted Dixon, and Ellen Brown. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.